Okay, sir.
Let him join. Okay, good morning, friends. Today we are going to continue with our discussion portfolio management chapter, wherein we started discussing risk and return profile of the portfolio management chapter. Yesterday we completed the risk return profile completely, correct? We solved up to question number 6 and question number 7. One second, question number, yes, question number 6, up to question number 6 yesterday we discussed, and question number 7 we will learn after some time. Okay, we will leave it there. Question number 7 is yet to be done. Question 8, we will start with Markowitz portfolio theory. Before that, we will have a quick recap of whatever we studied under risk return profile. Okay, so this chapter portfolio management is all about discount rate discovery. See, valuation of any asset as per the discounted cash flow method is nothing but present value of future cash flows discounted at required rate of return, correct? Present value of future cash flows is a clerical activity and it can be done easy way. Okay, it is better to it is easy to find, easy to predict the future cash flows rather than finding the discounting rate. So all the entire discussion made in this chapter is regarding the discount rate you use for valuation, okay, which you use. Ideally you use KE for discounting the equity based cash flow, cash flows of the business, you discount it by cost of equity. So the KE, the required rate of return of the equity holders, is only discussed in detail in this chapter, wherein two things we will learn. One is that how to measure this risk, how to find the risk of a security or portfolio as such, and then okay, after finding the risk of the portfolio, we need to find how much return we need to ask or we require. So that is required rate of return of the equity holders. This we need to understand. Then I told how to compute returns from the past data given. Okay, price at the year 1 minus price at the beginning, okay, plus dividend if any, the whole divided by price at the beginning. This is how you compute return, and then this the return you compute for each year. Each year you compute return using the past data. Okay, each year you compute the return. Then from there you need to find expected return or mean return. Okay, average return, you will find average return. This is what is expected. Same way, expected return, how to compute expected return in case probability is given, ex ante data is given. What do? You multiply the probability into the yearly return and then find the mean return, correct? Now after finding return, we need to find risk. Okay, how to find the risk? Risk is nothing but the deviation from the mean. Expected return is there, and how to find the deviation from the return is what risk is all about. That is what is denoted by sigma, sigma x or sigma y, and portfolio sigma also we learned. What is the individual risk of the security is nothing but, okay, the square root of, if you take post exposed data or past data, how you calculate sigma? Okay, sigma x is equal to summation of, okay, x minus x bar the whole square divided by n. If probability is given, what you will do? Okay, square root of sigma into p into, okay, sigma p into x minus x bar the whole square. This is probability. If probability is given, this is how you find sigma. Then what we discussed, okay, how to find portfolio risk and return. Portfolio risk and return, when it comes to return, it is nothing but portfolio return is nothing but a weighted average return of the individual securities inside the portfolio. But when it comes to risk, portfolio risk, it is not weighted average risk of the individual security. Why? Okay, it is because the presence of correlation. Okay, the portfolio risk is influenced by 3 factors and not the 2 factors. Usually return is influenced by only 2 factors, but risk is influenced by 3rd factor, which is called as co-moment of the securities or correlation of the securities, which is denoted by R. Upon there are 3 factors which is affecting the movement, okay, which is affecting the portfolio risk. What is that? One is the individual risk of the security inside the portfolio, then the proportion of these securities inside the portfolio, and then third is your correlation between the two securities or co-movement of the two securities, right? What is the correlation? We discussed formula and all these things. I discussed correlation will be -1 to +1, perfect negative, negative, -1 to 0 is called as negative, 0 is called as zero correlation, then 0 to 1 positive but not perfectly positive, +1 is perfectly positive. All these things I discussed. In correlation formula we saw what is the formula for correlation? Covariance of x and y, okay, the covariance between the two securities divided by sigma x into sigma y. Now, what is the covariance? Covariance can be found out under two methods, when the probability is not given and when the probability is given. When probability is not given, how to find covariance? It is nothing but, okay, the summation of what? X minus x bar into y minus y bar divided by n. This is how you find out covariance between these two securities, correct? When probability is given, what do you take? Okay, summation of p into x minus x bar into y minus y bar. This is how you find out, okay, covariance between these two securities, correct? Covariance you will find. Then after finding covariance, you divided it by sigma x and sigma y, the securities which you are trying to find, risk of the securities which you are trying to find, and we will get correlation. This is all about correlation. And when the correlation is perfectly negative, we found out the proportion in which minimum variance portfolio, the proportion of the securities, okay, can be arranged in such a manner that the risk can be even reduced to 0. What is that? Proportion of x is equal to sigma y by sigma x plus sigma y, and proportion of x is equal to proportion of y is equal to sigma x by sigma x plus sigma y. These things we saw, correct? Then we started solving questions, and one question project was there, and all about that I told you. Okay, company itself is a bundle of project or portfolio of projects. How they have calculated individual risk of these projects, and return is nothing but IRR there we calculated, and we saw till now, correct? With that we completed the risk return profile part of the first segment of this chapter, which is the foundation for the further discussion, correct? Now we will start with the theory, landmark theory. Late 1950s, Harry Markowitz came up with this theory, Markowitz portfolio theory. See, we will understand this theory through numbers, otherwise see, it will be difficult to understand this theory. So question number 8, 9 and 10, I will interchangeably, okay, use the data for discussion. See here, we have question number 8, question number 9, question number 10, okay. All these three are Markowitz portfolio theory related, and some extension is also there. The capital allocation line is there, which is obviously is an extension to the Markowitz portfolio theory. I told that all the discussion will be in a linear manner, wherein one topic will be there, thereafter other topic will be there. There is a connection, there is a flow to it, entire discussion, okay, there is a flow to the all these discussion. So what we will do, first we will take one by one, okay. Now we will discuss Markowitz portfolio theory, but in that one more concept if it is coming now, I will jump to the 9th question and 10th question, and then come back to the 8th question again, okay. So interchangeably I will use all the data for discussion purpose, correct? Right. So first we will start with question number 8, okay. We will understand what it is, then we will try to elaborate this Markowitz portfolio theory through this number. Take question number 8 for discussion. See, particulars security A, security B. Standard deviation is 20 for security A, expected return is 12 for security A. Come to security B. Security B, standard deviation is 40, risk of the security, individual security is 40, and expected return or mean return is 20. Okay. Correlation between these two securities is -0.2, correct? Calculate the return and risk of the portfolios for the different combinations of A and B, and explain with the help of data arrived the concepts of efficient frontier, utility curve, efficient portfolio, and portfolio with risk-free asset, and efficient portfolio, and portfolio with risk-free asset and efficient portfolio, and capital market line, okay. Please go through this question, take a minute time to comprehend the question, then we will start with our discussion. Okay. See here, the question noted down the data. Okay, security A, what is the risk, and security B, what is the risk. If you notice, okay, I can observe that security A is a low return security as well as low risk security, correct? See, security A is having a mean return of 12% and is having a risk of 20%. If you notice, security B is having a return of 20%, which means security A, advantage of security A is that it is having low risk. Come to security B. What is the advantage of security B? It is having higher return, but higher risk also, right? So, security A, we can conclude it as low return, low risk security. Security B, we can tell that it is high risk and high rewarding security, or high risk and high return security. Is this clear? Right. Now, what we will do? Okay, with this background, we will start discussing Markowitz portfolio theory. See. Markowitz portfolio theory. See, what I will do, okay, I have taken some different combinations, okay, of these securities inside the portfolio and built a different portfolio. For example, see, I can, portfolio 1 is there, first portfolio. Here there are how many securities in this question? 2 securities, security A and security B, correct? But here in this question they have not given in what proportion they have constructed. You need to construct the portfolio. Are you understanding? Which means I have not given the data to construct the portfolio. Understood? So what we do is that we will construct the portfolio using these 2 securities in a different proportion, and we will try to analyze what is the impact of these weightages. Okay, impact of the proportion we allocate to these securities, right? For example, I'll tell you what happens is, okay, first case, first we will build a portfolio 1, first portfolio. What we will do? We will build 3, 4, 5, 6 different portfolios, wherein we will use these 2 securities in a different proportion. Are you understanding? Now, for example, in our portfolio 1, can you all see the PowerPoint there? In the portfolio 1, we will prepare, wherein proportion A is 100%, which means we don't use security B at all, correct? Okay, 100% of your money is invested into security A. If that is the case, what will be the risk of the security? I told you, okay, if all the money is invested in single security, you don't need to go through all these portfolio formulas and all. Very simple. Risk of the portfolio will become risk of the individual security, because weight is 1 weight is 100%. There is no effect of correlation. There is no other security to measure the correlation. So when proportion of the A is 1 and proportion of B is 0, that is 100% and 0%, right? This is first portfolio. Okay, if that is the case, what will happen? Standard deviation will remain 20. The expected return will be 12. Understood this? First, now like this, okay, what we will do? We will construct different portfolios. Second portfolio, okay, when we see second portfolio, we will have 90% of security A, okay, and we will put 10% of security B, okay. Next, third portfolio we will construct. We will put 75.9%, okay, in security A and 24.1% in security B. Okay, don't question this number. This number is so sacred. I will also let you know how to compute this number. Okay, we will see at this point what is happening. Okay, this I computed and put it here. Okay, right. Next proportion 0.5 and 0.5, which means when we construct a portfolio using 50% of the money, if we invest 50% of the money in security A and the rest of the money in security B, then we will construct a fifth portfolio which is having 25% of our money put in security A and 75% of our money is invested in security B. The sixth option, what we do? We put nothing into security A and we put entire money into security B. Understood? This is how we will start, okay, putting various data and then try what is the impact of the portfolio. This is how Markowitz came up with his research. Shall we proceed? See here. Now what is happening? Return of the portfolio and risk of the portfolio. RP na return of the portfolio. Okay. Sigma P is risk of the portfolio. See, if our portfolio consists of A and B and A is 100% in our portfolio, the weightage given to A is 100%, then what will happen? Return of the portfolio will become individual return of the security, correct? Appo what is the RP if in case proportion is 1, return of the portfolio will be 12. Are you all understanding the number? Where I got from 12? See, how I got 12%. If I construct a portfolio having fully security A only, proportion is 1, 100%, correct? I have not I have not injected anything of security B. Are you understanding? Now what we are trying to do with this question, very simple. We have assumed security A alone. Understood? In the first portfolio, what are we having? Only security A, which is low risk, low return security. Security A is having low risk, low return security, correct? What we do, we will slowly inject, we will increase our proportion of security B with security A. Are you understanding? It is something similar to, you see, we have clean water. Understood? We have clean water in our, vessel. In a vessel we have clean water. What do? We slowly inject salt into it. Are you understanding? The proportion of salt is first, if you say 1 sip of salt, then we take 1 spoon, tablespoon, like that slowly you increase, then 1 tumbler of salt. Okay, then we are trying to analyze what is the impact of the mixture of these two. Are you understanding? This is what we are trying to do, which means in the first portfolio, if you notice, we only have security A in our portfolio, 100% of security A, correct? Clean, only security A is there, which means security A is what? Low risk, low return security. When we inject or insert, okay, slowly the high risk, high return portfolio, high risk, high return security into our portfolio, and slowly when we reduce the proportion of security A and increase the proportion of security B, what is the impact which is happening in the portfolio as such? That is what is the impact in the risk of the portfolio and return of the portfolio. This is what we are trying to analyze. Shall I proceed? Now you understood what we are doing. See, carefully observe. Portfolio 1 100% proportion is given to A, which means we don't have any B at all. Fully portfolio is constructed using A only, okay. Then the portfolio return is nothing but securities return, individual return. So what is the return of the A? 12%. Are you understanding? Given in the question, expected return is 12%. What is the risk of A? 20%. So risk will be 20%. This is clear. First row is clear. See, now in the second row, what we are trying to do, we will reduce the security A to 10% by 10%, which means 100% was our security A's weightage. We will reduce 10% from it and inject high risk, high return security into it. Understanding? Okay. So 90% of our security portfolio will consist of security A. 10% of our portfolio we are trying to inject security B, which is high return, high risk security. In case, correct? In that case, what will happen to our return? Return of the portfolio is nothing but weighted average return of the individual security. Correct? Okay. How to find return? 0.9 into 12% plus 0.1 into 20%. Correct? Okay. See here. Shall I?
Yes, sir.
And how to find 17.64? What is 17.64? Risk of the portfolio. If our portfolio consists of 90% of the security A, security B 10%, okay, then we have correlation also. Up a portfolio formula, how I arrive at 17.64? First you need to understand how to get 12.8%. Have you all understood how I got 12.8%? Return of the portfolio is nothing but weighted average return of the individual securities inside the portfolio. Correct? Up at 12.8, how I will find? I will find it by, say, multiplying 0.9 into 12 percentage security A plus weight of security B 10 percentage into 20. 10% into 20 is 2%. Correct? And 0.9% of 12% is how much? 12 into 0.9 is 10.8 plus 2 is how much? 12.8. So you are understanding how we got 12.8? It is portfolio return, weighted average return of the portfolio. Now risk, how I arrive at this risk? Okay, square root of W1 W1 square sigma x square, which is of course 0.9 square into sigma x square na 20 square, okay, plus W2 square, what is that? 0.1 square into sigma b square, which is 40 square, plus 2 into W1 W2 sigma x sigma a sigma b into correlation of x and what is that? A and B, security A and B, which is given as minus 0.2. Like this, if I apply this formula using this proportion, I will get the risk as 17.64. Have you all understood 17.64 how I got? You want to check or you can verify it later? Understood. Now how we formula, I don't want to solve the question here. You understood? I already solved it. This is, we are now interpreting the data and trying to find what the actual Markowitz portfolio theory is. Are you understanding? Now I don't want to sidetrack and calculate the number. It is already calculated, a given number. For interpretation, I am taking the number. Are you understanding? We are just trying to observe the behavior of this portfolio, right? See, so when we inject 10% of the high risk, high return security inside our portfolio, which is having predominantly low risk, low return security, what is happening? If you observe, our return is increasing. Why? Because obviously high risk security, high return security you are injecting, na? Understood? See, what is the return of security B? 20. Correct? Okay. Return of security A, mean return of security A is 12%. When I inject some portion of higher return carrying security inside of my portfolio, the return increases from 12% to 12.8%. First observation. Can you all see this? See here. 12% it was there in portfolio 1. Correct? It increased to, return of the portfolio increased to 12.8%. Correct?
Yes, sir. 0.8.
Yes, 0.8 increase. That increased. That is the main thing. Because you are injecting high return portfolio security into it. But to our surprise, risk has reduced even after injecting high risk security. Are you understanding? See, that is the beauty of this discussion. Which means, see, our portfolio consisted of fully of A, security A, which is low risk, low return security. Now I injected a significantly higher amount of risky security, which is security B, having a risk of 40%. Despite me injecting a 40% risk into this portfolio, okay, in the portfolio 2, yes, the return has increased, but to my surprise, risk has reduced from 20% to 17.64%. Are you all observing? Okay.
Yes, sir.
This is the beauty of diversification. I also discussed in one of the past question, which means despite having a higher risk, okay, I am injecting into the portfolio risky security, still my risk reduction happens. Why? Because of the correlation effect, because of the co-movement effect of this security, which is minus 0.2 na. So that correlation is reducing my risk. Are you understanding? So portfolio risk is lesser than the high risk security, individual high risk security, right? This is the second observation. Okay, what I will do, I will even try to increase it further. Okay, what I will do, I will increase in the third portfolio, I will try to, instead of 10%, I will try to inject more of security B. Shall we? See here. In the third portfolio, can you see the marker? See here. Third portfolio, okay. Yes, proportion A is 75.9. I reduce even further the weight of security A and I inject further security B. From 10%, I inject more because it is reducing risk. Security B is more favorable. Na? it is reducing risk, also it is increasing return. So I will see what is happening if I inject 24% of the 24.1% of the security B. What is happening? My return of the portfolio becomes even higher, 13.93, and my risk of the portfolio becomes 16.21. Are you understanding? This is all calculated number. You can go home and verify. Understood? Now, what is happening? Again, return is increasing further and portfolio is reduced again. Portfolio risk is reduced. Are you understanding? Despite injecting more and more risky and more high return giving security. Understood? Now, so what I do, I have become very excited. I will start injecting even more of security B, right? This is beautiful now. Return is also increasing, risk is also reducing, which is win-win situation for me, right? I never lose because risk also reducing. I am reducing the portfolio risk also. I am increasing the portfolio return also. This is so favorable. So what I do, I reduce further security A's weightage and I increase security B's weightage, right? I make it 50-50 instead of 75.9 and 24.1. Are you understanding? We will do what is happening? Then return is increasing further. 16%. Return has increased from 13.93 to 16%. How I got 16%? Weighted average return of the individual security. Correct? Up 50% into 12, which is 6%, plus 20% into 50%. How much is that? 10%. Up 10 plus 6 is 16%. Are you all understanding how I got the 16%? Okay.
Yes, sir.
Then portfolio risk. To my surprise, the portfolio risk has increased further. Are you understanding? 20.49. Okay. Which means, see, initially I was expecting a risk of the portfolio to increase when I started injecting high risk security inside that. Correct? Risk kept on reducing till portfolio 3. And after some point, the return is increasing, but the risk also increasing. Are you all understanding? Okay. Why? Because the risk reduction happens only till the saturation point. It is not permanent. Okay. At some point, the risk reduction of the portfolio stops and the portfolio certainly, because of the higher injection of the high risk security, the portfolio risk also started taking over and it will also become risky. Are you all understanding what is happening? Right. Portfolio 4 return is increasing, risk is also increasing. Portfolio 5 when we inject furthermore, okay, 75% of security B it will even increase the return to 18%. Return will increase, yes, but my risk, okay, will also keep on increasing like that. Okay, if I do nothing with security A, if I don't invest in security A at all, if my portfolio consists of only security B, what will happen? Security B's individual return is 20%, that will become my portfolio return, correct? And portfolio risk, what is portfolio risk? 40%, simply because second thing we are not using, right? Now you have understood this table, all these observations, okay? Now I will further discuss this. Are you understanding? So conclusion, initially when we start injecting high risk, high return security into our portfolio, slowly the return increases, the risk also reduces. Okay, but at some point the risk reduction stops and return also increasing and risk will also increase after some point. This is the observation. Are you all understanding? Till now.
Yes, sir.
Now see, the beauty of this discussion is, see here, security A is low return. When I plot the graph, you will understand now how profound the discussion is. See here, security A is low return and low risk security, and security B is high return and high risk security. When portfolio has only security A, its return was 12% and risk is 20%. When we inject B into the portfolio, logically the return and risk should increase, but to our surprise, okay, return has increased, yes, as expected, but to our surprise, the risk has reduced from 20% to 17.64% or something. This is due to risk reduction on account of diversification or correlation coefficient. The risk reduction is also not permanent. Okay, after portfolio 3, the return increases and risk also increases. These are all the observations we made from the first table. With this clear? This discussion is clear? Shall I proceed? See here, these are all the observations I made from the table. That's all. Right, now come to the actual discussion. See here, when I plot the data, of these risk return, we have right x-axis la, okay, I have risk, understood? Y-axis la I have return, which means first we had a portfolio na, which is having 100% of security A and 0% of security B. In that case, what was our return and risk? See here, what was our return and risk? Risk was, assume risk 1 irukla inga, okay, the 1 is there na, assume the risk, okay, the risk is 20% and the return is 12%. Are you understanding? Like this you should understand. Portfolio 2 la what is happening? See, risk when decreases or increases or decreases. See in this chart, where risk coming to left side, this is the starting point na, the starting point 0 of the return and risk. In the, see here, can you see the mouse? See,
Yes, sir.
this is the starting point, correct? Okay,
Yes, sir.
if I move to right, if I move through the right of the what do you say, x-axis, the risk keeps on increasing, correct? If I come closer from right to left na, it is decreasing, correct? This is in case of risk. Come to return. Return means moving upward. If the point is moving upward, it means it is having higher return, and if it is coming from upwards to downwards, the return is reducing. Are you understanding? See here, which means in the first portfolio if you take, it is having a return of 12% and risk of 20%, correct? When I inject 10% into the security B into the portfolio, what happened? Return has increased from 12% to 12.8%, correct? Appa increase in return na, it is slightly more above na. See here, point 1 na katlum, point 2 is slightly above, but it is moving leftwards. Leftwards na, the risk is reducing. The risk got reduced from 20% to 17.16% or something, 17.6%, 64% or something, correct? Then from portfolio 2 to portfolio 3, come to portfolio 3, what is happening? The risk even further reduces, understood? From 17% to 16% or something, it got reduced, correct? Return also increased. Because of that, from 2 to 3, there is upward movement, which means upward movement means there is inclination. So the return has increased, but the risk has reduced. It came from right to left, correct? But after 3 to portfolio 4, this is portfolio 3 in a 75.1% of the X, 75.9% of the X and 24.1% of the Y. This I told you now already. Remember? Portfolio 3. From portfolio 3 to portfolio 4, what is happening? It is increasing. The return is increasing. Correct? It is moving upward, but it is started moving rightwards. Rightwards means the risk is increasing. Okay, the risk reduction happens only till the third point, only till the third portfolio. Fourth, fifth and sixth and all, if you see, it is moving upward. Yes, return is increasing. If you see here, the return is increasing. Are you all seeing? See, return of the portfolio is always increasing. 12%, 12.8, 13.93, 16, 18, 20. Correct? Which means every number in the graph, if you notice, the return is increasing. 1, 2, 3, 4, 5, 6, everything is moving upwards. But initially it came leftwards from right. Okay, which means to some point, to some extent, reducing of the risk happened. Thereafter, diversification will not help. After some point, diversification will never help, and your risk will start to increase again. Are you all understanding? Okay. So, what is this Markowitz says? Na? Very simple. This is what I called as, so the 1 and 2 is there. Na? These are lying below 3, 4, 5 and 6. Correct? So, these are all inefficient portfolios. These are all inefficient portfolios. This is what Markowitz says. Okay? The portfolios which are coming under the 3 are all inefficient portfolio. Which means, if you carefully observe, okay, this is what he is going to say. But one more thing I want to discuss before jumping into conclusion. See here. Here in this question, the correlation given as minus 0.2. Correct? Are you all understanding? Here in this question, the correlation is given how much? Minus 0.2. Correct? Now, I told you in the previous discussion, minimum variance portfolio, when the correlation is minus 1, the risk can even be reduced to 0. Are you understanding? Portfolio risk, adana risk-free security, risk-free return, we computed in the question numbers, past question numbers, 4, 5 and 6 and all, we computed risk-free return. What is that?
Yes, sir.
Because if the correlation we can reduce to, if the correlation is exactly minus 1, we can even reduce the portfolio risk to 0. If the portfolio risk is 0, this is the portfolio risk when correlation is 0.2. If you notice the portfolio 3 is there, see here, portfolio 3 is there, the point. This is the point at which the R is 0.2. Maximum risk reduction happens. Are you understanding? Maximum risk reduction happens at 0.3. How to find it? I will tell you. There is a formula again. Are you understanding? When the correlation is exactly minus 1, what will happen? See here, the line will touch the y-axis. Why? It is risk is 0. It can even touch the y-axis. It will touch the y-axis. Okay, then it will move upwards. Are you understanding? In this question, they have given the correlation as minus 0.2. But if the correlation is exactly perfectly negative correlation, minus 1, with some proportion, I told you in the previous class itself, in some proportion, we can even reduce the risk to 0, portfolio risk to. What is the proportion? We calculated, we derived a formula, proportion of x is equal to sigma y divided by sigma x plus sigma y. Proportion of y is equal to sigma x by sigma x plus sigma y. This we found out. I told you this is called as minimum variance portfolio in case the correlation is exactly minus 1. Correct? Here I am trying to parallelly bring up that discussion also. This question is given as minus 0.2 as correlation. So our minimum variance portfolio is something different. Understood? And the formula we cannot apply here because there we used 0. We can and equated the formula and got the formula. Correct? Here the risk, portfolio risk will not be 0. Yeah. Okay. So we have a different formula. Markowitz gives us a different formula for minimum variance. Okay. Now the issue is not that. The main issue is that you need to understand when the correlation is exactly minus 1, we can reduce the risk to 0 or not. When we can reduce the risk to 0, what it means? The risk line is there, the portfolio, it will touch the y-axis. Are you understanding? Because risk, the risk is there, the risk will be 0 and the point of tangency, the risk will be 0. Correct? Then, yes, it will touch. See here, it will slowly, it will touch. It will, the move arrow, can you see the arrow? Left side it is moving and touching the return first. Okay, this will happen maximum reduction. So when this is when correlation is exactly minus 1. Understood? When correlation is exactly minus 1, our portfolio can be constructed in such a proportion that even the risk can be reduced to 0. At that point, when the risk is, portfolio risk is 0, it will touch the y-axis. Then, if you start increasing the proportion of the B more and more, what will happen? It will move upwards and rightwards. Risk will start to increase after some point. This is what it will happen. In this case, it was curve, okay. In that minus 1, it will become an angle. Are you understanding what will happen? Okay. Very, very simple part. Okay. See here, R is equal to minus 1. I have written there. R is equal to minus 1. Similarly, okay, what is happening? The risk will also increase if R is positive 1. See, when R is positive 1, what will happen? I told you what will happen if R is exactly minus 1. What will happen if R is plus 1? If R is plus 1, there is no diversification, there is no impact of the diversification. There is no risk reduction due to diversification. I told you when R is plus 1, you can never reduce the risk. Understood? In that case, the line will never move leftwards. The one portfolio 1 is there na. Are you all seeing the portfolio 1 here? Mouse theriyirda.
Yes, sir.
From portfolio 1, if the R is plus 1, there will be no risk reduction due to diversification. Which means, if we inject security B in any proportion, it doesn't matter, yeah. It will increase return alone, but not risk. Appo, directly it will move rightwards, risk will increase. Because you are putting a higher risk security into the portfolio na. So risk will also increase, return will also increase. You cannot reduce the risk due to diversification. Understood? Because R is positive 1. When R is positive 1 from portfolio 1, it will move only upwards and rightwards. It will never move towards the left side. Are you understanding? But in other cases, okay, if R is minus 1, it will even touch. But in other cases, it will move to some point, to some extent, that is called as minimum variance portfolio. Portfolio 3, we are having na. Till that point, risk reduction will happen. After some point, it will start moving the right side. Okay, after that, risk reduction will not, benefit of risk reduction will vanish, and slowly the risk will also increase and the return will also increase. This is the observation from this diagram. Puriyarda? Shall I proceed? See here, I have given. We can observe that the curve first moves leftwards, correct? Upwards, leftwards and upwards. Initially, first discussion, when correlation is 0.2, as per the question given, okay, it happens. Because introducing B reduces risk and increases return, correct? After some time, portfolio 3, after portfolio 3, what is happening? It is moving upwards, but it is moving towards right, correct? It turns and begins to move rightwards, upwards. Upwards is, of course, return is increasing, now it will upwards. Now, y axis, so it is increasing. I.e., return and risk both are increasing. Okay, portfolio 3 is referred to as minimum variance portfolio having lowest risk. Are you understanding? See, if my correlation is 0.2, okay, the portfolio 3 will become my minimum variance portfolio. Are you understanding? See, is this clear? Alright, you want me to repeat again?
No, sir. This graph is clear.
Clear, yes. In this graph only, I am observing one more thing. See, making an observation. 3.3 is the portfolio 3. Okay?
Yes, sir.
Portfolio 3, we have used a proportion of 75.9% and 24.1%. Correct?
Yes.
If the correlation of this portfolio is minus 0.2, it is given in the question, which means for a given level of correlation, what is the maximum risk you can reduce of the portfolio? This is what is called as minimum variance portfolio for a given level of correlation. Are you understanding? So here R is minus 0.2. If R is minus 1, you can reduce even with some proportion, use that formula and we can reduce it to 0. Correct? Here, in this question, can we reduce our portfolio to 0 or we cannot reduce? We cannot reduce.
We can.
Because there is no correlation of minus 1. Only when the perfect correlation is there, we can bring it to 0. That is why, in fact, the point 3 is not touching the y-axis. It is hanging in between. It is not touching y-axis. Leftmost corner, it is not touching. Why? Because for this portfolio, for this correlation between these two securities, the maximum risk reduction happens at 0.3. And it cannot be brought down to 0, yeah, because the correlation is not minus 1. Only when the correlation is minus 1, the portfolio risk can be reduced to exactly 0. Okay, here the correlation, since it is not perfectly negative, we cannot bring it to 0, but there will be some maximum risk reduction at some proportion, correct? That happens to portfolio 3, that happens till portfolio 3, at portfolio 3 actually. Till portfolio 3, it will keep on reducing, but maximum risk reduction happens with this correlation in this portfolio is happening on the what portfolio? Third portfolio, portfolio number 3. Are you understanding? Because thereafter, portfolio 4, risk is also increasing with return. So that is not preferable. Are you understanding? Which means portfolio 3, portfolio 4, portfolio 5, portfolio 6, thereafter risk is increasing. Starting point is maximum risk reduction happens at portfolio 3. Now we are used to 75.9% and 24.1%. Okay, how we compute this? We have separate formula for computing minimum variance portfolio for a given level of correlation. Are you understanding? Here correlation is not perfectly negative, so we cannot bring it to 0, but we have a formula. The minimum variance portfolio is calculated as this. Portfolio A is equal to sigma B square minus sigma A into sigma B into correlation of sigma A and B, correlation of A and B, the whole divided by, okay, sigma A square plus sigma B square minus 2 into sigma A sigma B, correlation of A and B. Are you understanding? This is the proportion in which I can reduce my portfolio risk to a maximum level for a given level of correlation. Are you understanding? Okay.
Yes, yes.
My correlation is minus 0.2. Up minus 0.2 if I am having correlation. Now for this correlation, for these two securities, maximum risk in what proportion I need to invest A and B in, okay, so that my risk reduces maximum. Okay, this you will find out using this formula. This is called as minimum variance portfolio. Proportion. What is PA? Proportion of A. அதாவது A proportion in this question we computed as 75.9% na? Correct?
Yes,
And 24.1% of security B. Correct? And the proportion of A 75.9% is calculated using this formula. You can go home and substitute and try. Okay, you will get the same answer. Or shall we substitute here and find the answer? Yes, we will find it and yeah, we will find and substitute the find answer. So before that, proportion of B also you see same way. Proportion of B is nothing but instead of numerator B square is then a sigma B square. Instead of that you substitute it A square. Sigma A square minus sigma A sigma B into correlation of A and B divided by denominator will be same, just like our previous same denominator will be same in both the cases. Proportion of A ki you use sigma B square in the numerator. Proportion of B when you are finding you use sigma A square in the numerator. That's the difference. Are you understanding? Baki variables, all the other variables will remain same. Okay, this is the formula. Shall we substitute the formula and find out? See here, proportion of A is equal to 40 square. See here, sigma A square, proportion of A na sigma B. How much is sigma B? Risk of security B 40. 40 square. Okay, minus 20 into 40 into minus 0.2. Correct? What is 20? Sigma A. What is 40? Sigma B. What is into correlation A and B? Minus 0.2. So how much is that? 20 into 40, you get 800. What is that number? 20 into 40 into 0.2. How much is that? 160 you are getting, na? Correct?
Minus 160.
Yes, minus 160. Correct? Minus plus correct? 40 square plus 160 divided by this number. Up 40 square, 40 into is equal to plus 160 divided by 1760 divided by this number. 20 square plus 40 square, okay, plus 40 square minus 2 into 20 into 40 into minus 0.2. How much you will get? See here, 0.759. Okay, this is what you are getting. Can you use the calculator and cross verify? See here.
Yes, sir.
20 into is equal to 400, memory plus 40 into is equal to 1600, memory plus plus 2 into 20 into 40 into 0.2. How much is that? 320. That I will plus 2320. 1760 divided by 2320. How much is that? 75.86 or 75.9. I am getting. Are you all getting the number? Okay.
Yes, sir.
75.86 or something. We have rounded it off to 75.9. At this proportion, the maximum risk reduction happens at this proportion. Is this clear? You know how to compute the. See, the examination you only need to know the formula and how to apply the formula. That's all. But for our understanding, you need to know what we did, na. This cannot be understood without understanding the entire Markowitz portfolio theory. Okay, I can simply tell that use this formula and solve it. You won't understand why this formula is given, what is to be done. Are you understanding? Now, proportion of B. Okay, how to compute proportion of B? Formula you should tell. Sigma A square minus, okay, sigma A into sigma B into correlation of A and B, the whole divided by, okay, sigma a square plus sigma b square minus 2 into sigma a sigma b correlation of a and b. This is the formula you will get by solving 24.1. Okay, of course. See, there are only two securities. You don't need to find again using formula. I told you now 1 minus 75.9 also you will get as 24.1. Anyway, because the total is 100%. Right. Next, how much the curve moves leftwards towards y-axis depends on the correlation coefficient. Are you understanding? So, what is the conclusion here? See, how much the risk reduction happens is due to the leftward movements. What the leftward movements denotes? Okay, leftward movements is all about risk reduction. Correct? Risk is x-axis. What is our x-axis? Risk na. Okay, so if our x-axis is risk, when it is moving leftwards from right to left, risk reduction will happen. Okay,
Yes, sir.
if it touches the y-axis, it is 0. The portfolio risk will touch because the risk is 0 at that point. But all the security will not touch it. Why? Because only -1, the securities, two securities having correlation of negative, perfect negative correlation, they only touch that portfolio will only touch the y-axis. We can bring it to 0. Other portfolios which is having a lesser correlation, okay, it will move leftwards, but how much it will move is denoted by this correlation coefficient, determined by the correlation. Are you understanding? Okay.
Yes, sir.
If the correlation is -1, through optimum proportion, the risk can even be reduced to 0. The lines move leftwards, not curve up to 0, and then makes a right turn. In previous segment, we have already discussed the way to calculate this proportion as follows. What is that? This is simple. Can you remember proportion of A? If correlation is -1, I am telling. What is the proportion to bring portfolio risk to 0? Proportion A is nothing but sigma B by sigma A plus B. Proportion of B is nothing but sigma A by sigma A plus B. This is how you compute proportions of these to bring it to 0. When R is +1, there is no risk reduction due to diversification. The line moves always rightwards and upwards. Are you understanding? Right. Next, okay, efficiency frontier. Because before I discussed, copy this down. Okay, then I will discuss the efficiency frontier. Okay. Yes. Question number 8. You can. Okay. Let's get back to the discussion. Now, we will move on to efficiency frontier. Now, see here, stage 1, efficiency frontier. See, we got a curve in the first stage. See here, we have correlation of 0.2 and we got the curve here. 1, 2, 3, 4, 5, 6 are there. Correct? Now, see, what is the frontier which you are getting from 3 to 6, from portfolio 3 to portfolio 6 are called as efficient portfolios, are all efficient portfolios. See, what is efficient? I will tell you. Portfolio 1 and 2 are inferior to portfolio 3. Sir, how can you say that portfolio 1 and 2 are inferior to portfolio 3? It is because, okay, for the same, see here, portfolio 1 is having, see here, one second, I will illustrate you better, I will illustrate you with notes. Then I will get back to the PowerPoint again. See. There are 3 situations when you call, see here, efficiency frontier. Okay, see here, x-axis and y-axis, here risk, okay, return. Here 3 things you can consider for comparing the portfolios or securities, okay, and analyze which is inferior and which is superior. For example, a portfolio is called efficient portfolio. A portfolio is called efficient portfolio when there is no other portfolio which gives more return for lower risk, more return for lower risk. Okay, this is first point. More return for lower risk, more return for same risk, more return for same risk, same return for lower risk. Are you understanding? Okay, these three, if any one of these three is there, it is called efficient portfolio, which means அதாவது any one of these three is na, this will become inefficient. If any one of these satisfied na, this portfolio will become inefficient. See, efficient portfolio. Okay, what do you mean by efficient portfolio? When there is no other portfolio which is giving more return for a lower risk. Are you understanding? Suppose there is portfolio A and B, very simple. We plotted na, very simple. First case eduthuko, we plot, this was portfolio 1, correct? This was portfolio 2, this was portfolio 3, the portfolio 4, 5, 6, and we joined it like that, correct? This was the curve na, efficiency curve.
Yes, sir.
4, 5, 6. Now here we need to check whether what are all the portfolios efficient or inefficient. Now portfolio 1 and 2 are inferior portfolios. Why? Because see here, portfolio at point 1, what was our return and risk? 12% return. Risk was 20%. Correct? At point 2, the risk was reduced. Na? The return is 12.8%. Risk is 17.64%, which means it is giving a higher return for a lower risk, more return for a lower risk. Correct?
Yes.
Upper portfolio 2, since it is giving higher return with lesser risk than portfolio 1, portfolio 2 is superior than portfolio 1. Correct?
Yes, sir.
And portfolio 3 is how much? What is the number we got?
Return is 13.93.
16% return, or 13.93. 13.93 was the return. 93 was the return. Risk was 16.
16.27.
Okay, any number, 16 number. Correct? Appo here 13.93 is higher than 12.8 and 12. Correct? It is giving more return for a lower risk, na? Correct? So portfolio 3 is superior to 1 and 2. Is this clear? Portfolio 3 is superior to 1 and 2. Why? It is giving more return for lower risk. Yeah? Are you understanding? So easily portfolio 3 is superior.
Yes, sir.
Because risk also is less, return is also high. See, not only this, if any security portfolio gives more return for a same risk, then also it will become inferior. We are going to solve. Next question number 9 is the question number 9 we are going to solve anyway. But before that I am trying to understand what it is actually. See here. So 1 and 2 are inferior, outright rejection. Correct? We will reject 1 and 2 portfolio. We will not construct portfolio 1 and 2 at all. There is no possibility at all. Why? Because easily we can construct portfolio 3 which is giving a higher return for lower risk. Na? Are you understanding? Which means 1 and 2 are inferior to portfolio number 3. Portfolio 5, 6 and 4, 5 and 6 are there. Na? Okay. They are giving more return for same risk. No, risk is also increasing. Correct?
Risk is higher.
Same return for lower risk. No, they are giving higher return. Appo, all these are superior. All these are efficient. 3, 4, 5 as well as 6. Are you understanding? Which means this was the total curve. Out of that, if you remove the 1 and 2 inefficient ones, okay, this is x-axis, this is risk. If you remove the 1 and 2 inefficient one, 3 will be there, na? 3, 4, 5, 6.
6.
Okay, all these are efficient portfolios and this is called as efficient frontier. You are getting the frontier na, இந்த மாதிரி ஒரு கர்வ் கிடைக்கிறதுல, this is called as efficiency frontier. Okay, this is nothing but a frontier. Okay, this is the curve which we are getting. All the portfolio, see here what is happening. As per Markowitz, we have here na, see here some portfolio might be there, here some portfolio might be there, here some portfolio, here some portfolio, here some portfolio. Okay, individual security, portfolio security, all these will be there. Correct? These are all, the dot points are all inferior. These are all, okay, inferior or inefficient portfolios. Why these are inefficient? You see, assume this circle, this dot is there na, okay, this dot is inefficient. Why? Because for the same risk, same amount of risk, this is risk na, correct, inge or portfolio will be there. Assume 5 is here, correct, here 5 is there, here the dot is there.
Yes, sir.
Correct. For the same risk, portfolio 5 is giving higher return. Correct?
Yes, sir.
This point will earn only lower return. Yeah, return graph is this na. This is only, this is 10% and this is 15%. So this is what is happening. Are you understanding? Which means everything below this frontier, okay, are called inefficient portfolios. As per Markowitz theory, this is what his theory is. Are you understanding? What portfolio are inefficient, what portfolio is efficient. Okay, security, it can also be applied to individual securities as well as portfolios. Portfolio is nothing but group of assets. Correct? The same logic applies to individuals, which means same logic of the individual securities applies to portfolio, right? So you can call it as individual security as well as portfolio of securities. It doesn't matter. Frontier, whatever is below the efficiency frontier, everything is, you know, these are all inefficient portfolios. These are all inefficient portfolio. Are you all seeing the red marking? Okay, the below that everything is become inefficient. Seeing okay, why? Because for a same level of risk, there will be one of the point which is falling under efficiency frontier, which will give higher return for the same risk. Are you understanding? One thing is that you may ask, sir, there is one portfolio, I have found out one portfolio which is above the efficient portfolio, efficient frontier. Understood? You might ask, sir, I am finding a portfolio which is above my efficient frontier. Then what it will happen? Then all the efficient frontier, the portfolios which are falling under efficient frontier are inefficient. Like that you should not think. If you find something above the inefficient frontier, the frontier itself changes. Yeah, the frontier itself changes. Are you understanding? If see the furthermost point, that will become the new efficient frontier.
Yes,
are you understanding? So below that everything will be inefficient only. So it is all about discovery. Unless you find a superior instrument, all the other, you cannot say others are inferior. When you find the superior instrument, of course, everything is, all other instruments are inferior. Correct? See, if we are not aware of, suppose, first Jupiter, when the Jupiter planet was not discovered, correct? Assume, long ago, correct? We thought everything was, the number of planets was only this much, correct? See, only when you discover something, then you add to your tally, correct? For Jupiter and Saturn, these many moons are available, correct? How are you telling? There was some person, Galileo, ellaru invent pannadukapram you are telling. Are you understanding what I am trying to say? So, like that, if you found out new portfolio, correct, which is even more efficient than existing portfolios, that frontier becomes new efficient frontier. Is this clear? Are you understanding?
Yes,
It doesn't mean these are inefficient. It just means that the new will become efficient frontier. The new curve will become your new efficient frontier, and of course all these, including these, will become inefficient because you have something superior, you found out. So until you found out that, you cannot say that is your efficient frontier. Are you understanding? Now, I will move back to the slide because, see here. See, portfolio 1 and 2 is inferior to portfolio 3. Can you all see this? Okay, portfolio 1 and 2
Yes,
is inferior to portfolio 3 because it gives higher return for a lower risk. Why lower risk? Of course, it is moving leftwards, na? So lower risk. It is moving upwards, so higher return. Higher return for a lower risk, na? Why to take higher risk? Which means these are inefficient portfolio. 1 and 2 are clearly inefficient. Come to portfolio 3, 4, 5 and 6 are all equally good because no portfolio is inferior to other. These portfolios are called as efficient portfolios. Correct? A portfolio is called as efficient portfolio if there exists no other portfolio that gives more return for lower risk, more return for same level of risk and same return for lower risk. Which means if your portfolio is giving a return of 20%, understood, and which can be earned even by taking less risk, na, your portfolio will become inefficient. Correct? Okay. The last one is only tricky. First two is easily understandable. More return for lower risk and more return for same risk. Of course, return side. Risk side also, if you see same return for a lower risk also will become inefficient. If there is a portfolio which gives same return as your portfolio, but for a lower risk, na, that will become inefficient. That will become efficient. You will become inefficient. Understood? Clear? Shall I proceed? See here.
Yes, sir.
The curve in which all the portfolios are efficient is called efficiency frontier. All the portfolios below efficiency frontier, I told you na, dot, I just showed you na, through the one note. That is what all the portfolios below the efficient frontier are all inefficient portfolios and there will be no portfolio above efficiency frontier. If such portfolio exists, the efficiency frontier itself changes. Are you understanding? See here, efficiency frontier, diagrammatic representation, risk and return, and from 3 onwards it changes. 3, 4, 5 and 6. This is all about efficiency frontier. Is this clear? Correct? See, what we did till now is nothing but, okay, we introduced you to Markowitz portfolio theory, wherein we used the question number 8. Okay, you may ask, sir, you have given only 2 security portfolio. In the market, there will be hundreds and thousands of securities. Okay, two securities you need to find. It may not be easy. Finding two security risk is not equal to hundreds of securities. Na? Portfolio which is consist of hundreds of securities. Na? See, manually we are not going to compute. We are going to use computer. Na? Anyway, are you understanding? So it is possible. It is very easily possible. You have the risk data, correct? You feed all these data into system. It will automatically show you the efficiency frontier. Are you understanding what I am trying to say? Very simple. In the data plotting, plotting itself, I will show you in our concept book if you notice. Okay, the data chart is there, na? Insert feature of the word. If you insert a chart, and if you the pop-up window will come, Excel window, wherein you can set the x-axis point and y-axis point. Yeah, it will automatically show you the curve. Are you understanding? So everything is computer driven now. You don't need to ask. Only thing you can ask about this is, sir, you are computing everything for 2 risk security, but in reality, market, Sensex, Nifty, how many shares are getting traded in NSE and BSE? Correct? For all these, if you sit individually and compute portfolio, now how difficult is that? You may ask. Yes, there is practical difficulty, but you are not manually doing. Yeah, you are putting data into computer. It can automatically collect the data and put it. Understood? So it is not as difficult as you think. Understood? Right. This is the only question people ask this question. That's why I answered. Okay, efficiency frontier. Now we started from the given data. We found out, we plotted the points using the risk and return of the portfolio, and then we found out portfolio 1 and 2 are inefficient portfolios. So we removed the portfolio, those 2 portfolios from our efficiency frontier, and found that 3, 4, 5 and 6 portfolio form a curve which is called as efficiency frontier. Below this curve, all these portfolios which are falling below are inefficient portfolios. This is the conclusion till now. Is this clear? Shall I proceed?
Yes, sir.
Okay. Now to come to second part, stage 2. Okay, utility curve. What is utility curve? I will illustrate. See here. First you found out efficiency frontier, correct? That is with regards to the market, correct? Market what is happening you need to find, and you found out. Okay. Now which means understand you are trying to marry a girl. What do? You go to matrimony website. Okay, all this list you will see, correct? Then you will select. All these things happen, or you are going to job. For easy understanding purpose, I'll tell you this. You are going for job, correct? You go visit some website, naukri.com or any other website, and job portal, various jobs will be given. Then you make application, then you will join, correct? Now same way here, efficiency frontier is one stage of discussion. Now that is market. What are all the portfolios which are available in the stock market for you to invest is captured by the efficiency frontier. Are you understanding what is happening? But when it comes to, it is a investing is all about, okay, a collegium of two things. One is the securities available in the market. Then there is investor. Investor has to choose the security, correct? Are you understanding? Jobs are available, yeah. Jobs are listed in the portal, job portal.
Yes, sir.
But for you need to apply for your specific job, You need to search for the job which will be favorable to you, correct? That is why I told you marriage also. If you see the list, you need to see the specifications and select, yeah. Like that, utility curve discussion is all about investors. Okay, investors also have some problem in the sense they have some limitations. Okay, there are various types of risk takers. Okay, it depends on investors' risk appetite. Are you understanding? Selecting the market portfolio is not only the function of market in itself, it is also the function of the investors, correct? Because investor is only going to take an informed decision about the investing proposal, correct? The proposals, different investment opportunities are available in the market which are captured through efficiency frontier, correct? Through efficiency frontier, I understood that I should not invest in inferior security, correct? I should only invest in those securities which are falling under efficiency frontier, which are falling on the efficiency frontier. That is correct. But I need to decide if at all I need to invest or not. That depends on the risk appetite of myself. For example, in our example of efficiency frontier, we have 4 different portfolios which are falling under efficiency frontier. For example, portfolio 3 is also forming part of efficiency frontier. Portfolio 4 is also efficient. We discussed 1 and 2 are inefficient. We removed it. Correct? 3, 4, 5 and 6 all are efficient. Understood? All are efficient. Which means 3, 4, 5 and 6 all are efficient. But 4 is having more risk, more return. 5 is having even further more risk and more return. 6 is giving even more return, but for a higher risk. Appo 3, 4, 5 and 6 is having more return is correct, but is having same level of risk, varying level of risk, increasing level of risk, increasing level of risk, correct? Appo how much risk I should take also determines which portfolio you select from efficiency frontier. Am I correct? See, for example, I am saying that okay, Reliance company is giving me 20% return in the market, correct? For a 10% risk. Okay, there is also one more company, Infosys, suppose assume it is going to give 25% return for 15% risk, correct? But not all the investors will select the same security. Are you understanding? Which means a person who has a higher risk appetite, who has a higher risk appetite, which means he is okay, he can't further take the risk, he is excited to take risk for a higher return. Are you understanding? I say that Reliance company is only giving 20%, Infosys will give 25% return. Okay, but I will say one caveat is there, one condition is there, risk is higher. For Infosys, it is 15%, but Reliance 10%. If I tell you, okay, a person who is having higher risk appetite, who can, okay, take higher risk, who is willing to take higher risk, what he will do? He will select Infosys, yeah, because for him return will be more attractive, the 25% return will be more attractive than the risk factor. Are you understanding? This is what we will see in this segment, utility curve. In the utility curve, we will decide from the investor's perspective how much risk he is willing to take, what are all the different types of investors, all these things we will see from investor's angle. Are you understanding the two angles are now? Okay, in this point number 1, efficiency frontier, all these portfolios which are lying in efficiency frontier are efficient or inefficient? Efficient. So equally good. Up portfolio 3, 4, 5, 6 all are equally good, correct? So which portfolio I should select, you will ask, correct? Depends on your risk appetite.
Yes, sir.
Depends on how much risk you can take. Are you understanding? Okay, very simple pa. Now I want to marry Aishwarya Rai nu. Okay, will it happen? Okay, I want to get 100% return. Will it happen? No. What I should do? Seri, illa, adda illa, Aishwarya Rai da illa. Okay, Bombay based actor da illa. Local actor da kadairan paakra. Okay, second choice. Da adum kadaikala, then you okay, I am not demeaning anyone. I am just telling very choice preference. Okay, don't mistake. Just for example purpose, don't think I am racist. Local based actor mosama adin kekada. Okay, don't ask like that. Just for example purpose, I am telling you. You will find preference. See, when you decide using matrimony website, you will see, okay, in the look, how much salary. Salary is a 40 lakhs per annum package. Irka. They will see. If not there, say, na pandrathu. Okay. Then next, 30 lakhs per annum irka. We will see, everything, selection, whenever you try to select, whenever you have given option to select, you will select maximum, beneficial scenario, Okay. Ideally, you will not choose from first, you will not choose from down, You will try to increase your expectation. First time, expectation will be in the peak. Then, it will slowly reduce. Same way, investor also, okay, they will have in mind what is the maximum level of risk I need to take, okay. Then accordingly, I will try to buy a security or portfolio which is giving a return for the same risk. But you can change your decision by return. For example, Infosys is having 15% higher risk, correct? In our example, I told you 10% risk Reliance is having, 15% risk is Infosys is having, and Infosys return is 25%, Reliance return is 20%. Now, some person might feel for the extra 5% of risk undertaken in the Infosys, the 5% return compensation is not enough. Understood? Have you all seen this? When you go to, today, when I ask very simple, to understand the risk perception, I will tell you one example, okay. If we go to our, some years back, okay, or we can simply say in our house itself, if you go to our dad and say that we are going to invest in equity market, or you tell them, ask them to invest their fund in share market, will they agree? If you see one generation back, they will never agree to invest in share market. Are you understanding? Okay.
Yes, sir.
The person is older than 50 years, he will in a share market. What is there to share market? I don't need return. If you offer him 25% return, they will take. I will put it in bank FD and I will earn a riskless 8%, 10% return. Why should I go to the share market and with extra risk I should go to the share market? I will never go. Like that they will say, Have you understood? Go ask your grandparents. They will tell you. They will tell you all the scams about, past scams about equity market, and they will tell the share market, never invest in share market. Why to invest in share market? Like that. Okay. Others come to other way around. If you go to a 20-year-old or 30-year-old young person who is going for job and earning some salary, you go and ask him to deposit fixed return 8% return. Enna 8%? Share market la I am getting 25% return. This government of India bond is giving only 8% return. His focus will be entirely on the return return thing. Are you all seeing, understanding the difference? Investor's perspective. See, for an investor who is older, he will see only the risk, the negativity of risk he will see, and he will not invest in the markets. Understood? If you go to a young person, at the same time, he will never see the risk angle. Risk higher, I don't care. It is giving higher return. I have a chance to earn a higher return. So I will exercise that possibility. Understood? This is what the thinking will be for the young persons. Okay, like this, investors' behavior also dictates the portfolio selection. This is what we discussed in utility curve. Are you all understanding? Now we will discuss. Now we will go to the core discussion. This is a background I just gave you so that you can understand the further discussion. Can you all listen? See, in part 1, Markowitz have identified the best securities available in the market. Correct? Now the focus shifts towards understanding investor, because investor, the 3, 4, 5, 6 all portfolios are efficient only, but investors, all the investors may not select same portfolios or securities. Correct? It will depend on the investor's individual appetite. Let us see what is happening there. Persons can be classified into 3 types. One is the risk lovers, okay, risk neutral and risk averse. This is something new. We already discussed in derivatives. I already told you in various already discussed under various heads. So discussion becomes even more simpler. Very simple. Risk lovers are the persons who love taking risk and even be willing to pay some premium for taking risk. Very simple. Lottery ticket gambling is there. Okay, if we go to Goa, I have not visited, I am just telling, if we go to Goa, I have seen the casinos will be there. Ship, if you go to beach, there will be so many beaches, and the mid beaches there will be ships, and the ships is fully of casino ships. Okay, and how I know, you don't ask. There is a company which is based on that, Delta Corporation. I don't know whether you have, this is a listed company. Okay, when I studied the company, I know about those that company. Okay, which is into casino business, operating from various parts of country, Goa and other Nepal, all the areas it is operating, right? So the point is, when you go to the casino, there will be so many games, okay, and then there will be some token which we need to buy by using real money, and then the token has to be put and we can play the game. Correct? I have never seen ordinary persons winning those games. Always the computer will win. Are you all understanding? Which means the chance of winning will be very, very less. A lottery ticket, you can take lottery ticket for example. Lottery ticket is there, correct? One ticket is 20 rupees here, correct? You are paying 20 rupees as premium. It is something similar to premium in the options we discussed, correct? So it is something similar to pay premium. 20 rupees you are paying to buy a ticket, but what does the ticket actually mean? A chance of winning the 1 crore rupee lottery, correct? Now 1 crore is huge amount. But what is the probability of you winning that amount? How many tickets will be issued? Are you understanding? If you see that revenue from the tickets itself will be higher than the prize amount. No fool will offer you 1 crore rupee and then ticket order total will be 10,000. Anyway, you have to pay the winner. Someone will surely win the lottery. So the premium will be charged in such a way the total amount of premium will be higher. The risk lovers, what they will do, their probability, if you do the ex ante return la compute pannolla, appa probability based return if you compute using the 1 crore data, your chance of getting 0.000, like that, if you put the probability and compute the data, the amount will be far lesser than 20 rupees. Correct? Are you listening? What I am trying to say, can you visualize the point? Lottery ticket you are paying 20 rupees, okay, which is actually more than the fair value of the lottery. Understood? That because the chance of getting the 1 crore is very less, very meager, 0.00001%. Okay, if you put 0.0001% of 1 crore, it will be very less, 10 rupees. Okay, then which means you are paying premium. Risk lovers are those persons who are willing to pay even more premium to take risk. Horse races, okay, casino, gambling, all these are examples. Risk neutral, come to risk neutral, ignores risk angle, always selects the option having high expected return. Whereas risk averse person, unwilling to take risk. Okay, generally he will be unwilling to take risk, but you can only lure him through higher return by offering him higher return for a given level of risk. For example, if I say, okay, Reliance is, Infosys offering 25% return for 15% risk, which is higher from previous of 10% return, which is Reliance I had, na? Correct? But if I say, no, for just 5% return, I cannot take equivalent 5% risk, you have to give me at least 10% return. Up Infosys only if it gives 30% return from 15% risk, then only I will invest in Infosys. Like that, if you say, this is the classic example of risk averse person. Okay, risk averse person generally is unwilling to take, should be offered a premium to take risk. In the market, we assume that in the entire subject, all the persons are only risk averse. All the persons are risk averse only generally. Why? Because generally if you ask, 99.99% will be risk averse only in the market participants, I'm telling. Okay, because no fool will accept a same return for a lower risk. Yeah, understood? They will move to other security, na? Clear? See, these are all the three types of risk. Let us consider the two investment options. Assume that option 1, you have, okay, expected return is 50, probability is 100%, and option 2, expected return is 100 with 50% probability expected return with 0% return, $0 with 50% probability. Now tell me, in both the cases expected return is same. Understood? How to compute expected return? See here, expected return $50, probability 100%. The mean return is fixed. There is no deviation from mean. In option 1, there is no deviation from mean. Government of India, bond or risk-free security return, it is not having any risk. It is having any risk. There is any deviation in option 1? No. Come to option 2. There is deviation. Yes. There is a chance to earn higher return. Yes. 100 return you can earn. In the first option, there is maximum return you can earn is 50. But that is certain. In option 2, you can earn a higher return of 100. But that 100 itself is not certain. Yeah. Only 50% probability is there. And other 50% probability is given to 0. Which means your earnings can also become 0. Your earnings can also go as high as 100. Okay, there is a 50% chance. Which means 50% into 100 is how much? 50 plus 50% into 0 is 0. The total of expected is 50 in the first case as well as second case. Which one you will select? It all depends on the risk appetite of the investors. Okay, now see, the expected return is also 50. The expected return is also 50. The option 2 return is without having a deviation and certain with having deviation, uncertain return. Option 1 is having without deviation, certain return. Now what we will see now, these three persons, how they will behave. Okay, risk lovers, what they will do, will select option 2 obviously because of the possibility to earn higher return. Because I told you, risk lovers will see only the good prospect, higher return prospect is there, they will select that. Risk they don't care. So what they will do, they will select option 2 because it is having a possibility to earn 100. Why they are buying lottery tickets? Yeah, risk lovers, because there is a possibility of earning 1 crore rupee. The possibility might be very minimum, but they are leaving it to chance and they are taking a chance because they are risk lovers obviously. Then there is risk neutral. Risk neutral is a person like a sannyasi. Okay, he will never think about anything. Okay, only thing is he will ignore risk. He will never consider risk. Okay, he will only select whichever is giving same expected return. He is indifferent, which means he may select option 1, he may select option 2. Expected return 50 that is enough. Expected return is 50, that is enough. I am not bothered about risk at all. Okay, this we already studied in derivatives, risk neutral probability. Where we studied? Okay, risk neutral probability we studied, risk neutral model, binomial model, all these we studied. wherein we understood that under risk neutral model, all we assumed rational investors, all the investors are risk neutral only. We live in risk neutral world. As per the risk neutral world, how is the valuation happening? All these we saw under risk neutral model, correct? That
Yes,
we
sir.
already know. Okay, he will be indifferent. Yeah, that's the point. He will be indifferent between risky asset and risk free asset. Okay, next, risk averse. Risk averse person will select option 1 due to certainty. Due to certainty. If you want to make a risk averse person select option 2, you need to pay, you need to compensate with a higher premium. You need to compensate with a higher premium, right? See here, empirically it is seen that most of the investors are risk averse and the portfolio selection is made keeping in mind a risk averse investor. All the investors may be risk averse, but their degree of aversion to risk may change. Now see, next discussion, okay, all the persons in the market generally are risk averse. We concluded that, correct? I showed you how they require premium to take higher risk. They will ask for higher premium as a compensation for undertaking higher degree of risk. That is correct. Now, how much compensation they need will depend on how much risk averse they are. Correct? All the investors may be risk averse generally, but the aversion, degree of aversion is there, na? Okay, it will differ. Degree of aversion will differ from person to person. Okay, see here, a conservative investor is more risk averse compared to aggressive investor. Who is conservative investor and who is aggressive investor? I told you, a dad and son. Two persons are there. Dad will not invest in equity market. I told you, na. Okay, he may hesitate. Grandparent or parent, our parents will be hesitant to invest in equity shares. Why? Because it is offering return but is having higher degree of risk, na? They are unwilling to take risk. But if I tell you, see, sir, last in the matter 2006 to 2009, there was a peak period when markets gave 30%, 40% return, abnormal return they started giving. Okay, at that time, everyone mutual fund is giving 30% return, 30% return. There will be downturn also. But a lot of, now you are seeing how much advertisement they are doing, mutual fund sahi hai, all these things were there. They were in the peak. Then market crashed, that is different thing. Okay, at the end of 2008-9, market crashed because of the global financial crisis. 2007, the Lehman and Sachs banking system collapsed in US, na? So all these things happened and market crashed. The point is, the takeaway is that, yes, if you offer a higher return, they may get lured. Are you understanding? Even conservative person also will be willing to take risk, yeah? Okay, if you say that 20% risk is there for 20% return, you will earn from 10% risk. But if you take 20% risk, you will earn 60% return, na? They will obviously agree, na? Because it is more than double. Risk is from 10%, risk doubled to 20%. Return from 20%, it tripled to 60%, na? So they might feel, okay, it is worth taking the risk because the return, the compensation we are getting is too high. Like that, okay, every person, we can classify them as conservative as well as aggressive, correct? Conservative investor will be there who will be little more conservative, which means he will expecting more return for taking little higher risk, okay, than the aggressive investor. Aggressive investor will see the return angle and he will take, for a lesser amount of risk, he will take, for a lesser amount of return, he will take higher risk. Are you understanding? Both are risk averse only, but the aversion factor depends, aversion factor differs, and they will take decision as per their, what do you say, in appetite for the risk. Are you understanding? See here, for a given level of risk, the conservative investors expect more return because he requires higher risk premium for taking the risk. It is vice versa for aggressive investors. Aggressive investors will be happy to take risk even for a lower return. Are you understanding? That is the difference. The above can be understood through the following diagram. Investor type, okay, risk and return. This is from the investor's perspective. Okay, 2 points are there: conservative investor, aggressive investor. Can you see the diagram? Can you see my cursor? See here.
Yes, sir. Aggressive.
What is this diagram all about? I'll explain. Both are risk taker. Okay, both are risk lovers. Okay, assume that they are taking risk. Risk is moving rightwards, na? See here, risk is x-axis. In the x-axis we have risk. In the y-axis we have return. Correct? When start from 0 point, 0 risk is there, na? Go see the conservative investor. Conservative investors, okay, require for a given level of risk require higher return. That is why the graph is moving upwards, topwards, na? See, first yaroda line irukku, whose line is first? Conservative investor, which means very simple pa, I will tell you. See here, notes I will try to explain. Sorry. Y return, this is risk, correct? This is x-axis. We have two type of investors, okay, conservative investors and aggressive. This aggressive, this conservative. Now how this is conservative, I will tell you. Simple pa. Any given point you take in the graph, if it parallel, it is parallelly going upwards, na? Okay. Now any given point, assume this point you are taking, correct? This is 1% risk pa. Okay, this is 5% risk, na? This is 2% risk. Okay, now see, for any given point 1% risk is there. For aggressive investor, see, this is 5% return, this is 10% return, this is 15% return. Can we assume this? This is 25% return. Like this, can we assume? See, for 1% risk, okay, an aggressive investor can only ask for, even can only be, may only be satisfied with 10% return. Understood? But at the same time, if you see, a conservative investor will ask for 15% return for the same 1% extra risk. Are you understanding? Go to 2%. 2% la inge 12% vechiko. The same instrument, he will ask for 16 or 17% return. Are you understanding this clearly? Either mari 5% also, if you see, aggressive investor will ask for lesser return. We will be satisfied using lesser return. The point is, aggressive investor will be satisfied even with a lesser return. But conservative investor will never satisfied with a lower risk. He will ask for more premium. Are you understanding? Because he is conservative, na? This is the conservative, la. This is the example of our dad. Okay. Are you understanding? All the dad will be like this, na? If you notice, dad na or example ku solren. Okay. The previous generation person will be more conservative than this generation persons. Correct? They will ask so many questions. Yeah. Okay. They will never invest in mutual fund like what we do. We have bank account, PAN account. We will directly open demat. We play around. We will use our funds. Are you understanding? Yes. We will do that. This experiment, you go and ask your dad, yeah, will they do? They will never do this. They will say, why to spend 5,000? Why to play buying and selling? What is happening? You tell me. First they will ask for entire story. Okay, mutual fund, the person, have you all seen the person, the person who will be, selling, marketing team, mutual fund. They will be explaining the schemes. Insurance also will be there, na? Person will be coming to home. They will try to explain the scheme. Okay, you will marketing agent. They will try to tell, this much is there, that much is there, very superior. This scheme is there, that scheme is there. All this he will explain. Okay, if we explain to us, without explaining, we will start investing. But if we go to our one generation back, if we go to our dad or grandparent, what they will do now? They will ask all the experiment, all these experience. They will ask, they will hear all these from them for 4 hours. Thereafter, you will say, I will think about investing. Don't worry. I will inform you. You go home on today. I will later think and decide. Tell you, will go. Are you understanding? They will never invest. They will never get into this trap. Are you understanding? That is the maturity level. That is a conservatism. That's why I'm saying conservative investor na, you think like a dad or go to previous generation persons. Okay, aggressive investor na, today's world we are all aggressive. In reality we are all aggressive. Okay, example ku solra. Okay, current generation is generally aggressive. Okay, right? Which means what? You are satisfied with lower level of return. Okay, you are ready to take more risk for same return or lower level of return. Okay, but conservative investors require higher return for the risk undertaken. Are you understanding? Higher than whom? Higher than an aggressive investor. This is comparison between conservative and aggressive. In the end line, these two lines are comparative of each other. Are you understanding? Aggressive investor conservative investor comparison you are doing, drawing a comparison. Understood? All these understood? Investors type. Shall I proceed to the next discussion? See here.
Yes, sir.
One second. Slide showed from current slide. Okay. So investors either is there conservative aggressive investor. How much happiness an investment gives to the investor is referred to as utility. So the utility you are telling na. Okay. See, first we discussed efficiency frontier. Correct. Now we are discussing utility curve. This is from investor's perspective. Appo what is this utility curve na? It is nothing but satisfaction curve. Adavadhu these two lines we saw na. Dad and a conservative investor and aggressive investor, the parallel line, parallel upward curve, upward moving curve. This is nothing but a representation of happiness. Happiness in the sense satisfaction. Okay, a conservative investor will only be satisfied through higher return, but aggressive investor will be satisfied through lower return. Understood? Don't worry, this is going theoretical. Yes, it is little bit theoretical. Name a portfolio theories. Yeah. Okay, so there will be conceptual discussion rather than solving. Once I cross this every time, when I come to this discussion, it is little bit heavy. Once I cross this, you will be enjoying more, okay, subject more. You will understand. This alone little bit theoretical, but you need to understand. You need to understand both the angles, how we mix both this up. In the next step, we will more mix the investor angle as well as market angle when come to conclusion. Can you all listen? Patience required. Okay, some time, 15 to 20 minutes, we will finish it everything. Okay, see here.
Okay.
How much happiness an investment gives to the investor. Upon that second curve is there na. Okay, the two lines are two upward moving curve we draw in the graph, plotted in the graph. This is nothing but investor satisfaction, which means a conservative investor will only be satisfied with a higher return. That is why the line is running high na. First line, it is going moving upwards, na, top line, topmost line. This is giving higher satisfaction. When conservative investor will require higher return to satisfy himself for the risk undertaken. Conversely, when it comes to aggressive investor, he will be satisfied even with a lower degree of risk. Understood? So this is called as utility. This happiness or the satisfaction level is called as utility. Understood? Utility curve. This we are discussing na. This curve, aggressive, conservative. This curve is called as utility curve. Okay. Adile utility term meaning is nothing but happiness or satisfaction. The level of satisfaction. It's just an emotion of the investor. Okay. The utility is defined by the following function. See how you can identify the emotion. Yes, correct. The emotions are hard to catch. But there is some formula. This is also empirically proven. You should not question this formula. This is also empirically proven given the data level. Adavadhu, they have analyzed the data and come to a conclusion that okay, this can be used for understanding the utility as such. Okay, you cannot individually analyze all the emotions. Correct? It will differ from person to person, and there are millions of people around. Correct? Investors around. But we need to agree on a common term, na? Correct? So we need to agree upon a common term, which they have proven empirically also. This is economically accepted. Have you all foundation economics utility curve? Have you all studied utility curve?
Yes, sir.
Oh, so you already studied utility curve. You remember all these things or?
Not
Not everything, but some topic was there, correct? Utility curve.
Yes, sir.
That's right.
Yes, sir.
So this is empirically proven. This is all economically proven thing. Okay, you don't need to question the what is the formula and all, but this is what is there. So what is the formula we need to understand? The utility, very simple pa. Formula you need to by heart, but how they arrived at the formula, I will give you an explanation. See here. Utility is nothing but expected return. What is ER? What is the formula given? U is equal to ER minus half into A into sigma square. This is the formula for utility. Utility. Now, what do you mean by ER? Expected return. Okay, this is the expected return. See, very simple. When this ER is higher, more the utility will be to the conservative investor. For the conservative investor, he will require expected return to be higher or not? Yes. So, three factors affect the happiness pa. Very simple. The expected return, correct? Return, higher the return, you will be higher satisfaction. You will be satisfied more, correct? So, higher the return, higher the satisfaction level first. Then, sigma square. Lower the risk, higher the satisfaction. They are inversely proportional, which means more the risk, okay, lesser the satisfaction, correct? So, risk if it is low, you will be satisfied. That is why minus we are doing. Understood? ER, expected return, minus half into A into risk square. Okay? You can put it into bracket also. Half into A into sigma square. You can put it like these are negative terms. Negative variables. Expected return is possible, positive for us. If expected return is higher, we will be more satisfied. Correct? But it is not in case of risk. Risk, if it is lower only, we will get satisfied. And aversion. A is nothing but aversion factor. Risk aversion factor. Aversion factor, very simple. See, our happiness or our satisfaction not only depends on the securities return and securities risk, it also depends on our risk aversion. Are you understanding? How agitated you are to take the higher risk, it also captures the issue. That is also one of the main issue, which means how averse you are to this investment. That also is there, na? Are you understanding? Just like in correlation, we studied various factors which affect the correlation. Like that, here also, utility is affected by three factors. One is expected return. Higher the return is higher beneficial. Half into aversion factor, which means aversion factor, the more the risk averse person is there, the more return we will be expecting and less happy he will feel. That is negatively, inversely related. Same is the case of risk. Risk is also, the more the risk, lesser the satisfaction. Lesser the risk, higher the satisfaction. Are you understanding? Okay, so what is the utility formula? Is nothing but ER minus half into A is nothing but aversion factor into sigma square. Okay, the utility or happiness is influenced by three factors: expected return from the security, risk of the security, and aversion factor of the security. Expected return of the security means higher the expected return, more the happiness, and vice versa. Risk of the security, higher the risk, more the unhappiness, and vice versa. Higher the risk, more the unhappiness, and vice versa. Aversion factor magnifies the unhappiness due to risk, which means higher the aversion factor, even 10% of risk will look like 30% of risk. It is like a magnifier, when you see with magnifier, the same letters will seem very big, so this is aversion factor is exactly like a magnifying glass, which means risk will be 10%, but if you are more averse to risk, 10% will look like 100%. Okay, the 100%, like that you will think. Like our grandparent, they will think even further. They will even don't put their money into FD. Our grandparent, they will put into gold or very safe assets. That's the thinking. Savings comes first for older people. Elder people, always savings will come to their mind. Investment secondary. How to live a peaceful life will be their issue. Money is not a issue for a person who are above 60, above 70. They will always tell a simple word. Remember, if you tell about money to them, they will say, enna panna pora, enna irundu. I am only having a life of 10 or 15 years more. Correct? Or they will say, I am going up today or tomorrow. what I need to do with this money. This is what they will, philosophically only they will speak, correct? Am I correct? They will never care about money. They will care about happiness. They will care the wellness of the family. That's all. They have seen everything. They will never care about all these things. For us only, oh, goals, targets, this is the achievement, this is, I have to earn this much, that much, the dreams, all these things will be there when you are younger. Once you grow older, simply enjoy life, okay? That is the thing. Right, you understood the emotion, how it is all going? Okay. Now we need to link these two up. The aversion factor is determined by the answers given in the investor to set of questions. Yes, exactly. The aversion factor and all, how you can find it, you may have asked, very simple. When you go to any insurance based business or any classical example, I'll tell you, when you go to actually investment advisory services, equity research advisory services, then portfolio management services, PMS, you have heard portfolio management services, okay, private equity and all,
yes,
they have the firm, okay, they will offer SEBI registered investment advisor, okay, they will offer that. What they will do, first they will analyze the investor. There is a rule itself, SEBI rule, you have to analyze the investor, you have to understand the risk appetite of the investors, and then only you should advise. Aதாவது a person coming at 60 years of age, you should not lure him to invest in risky security. Only if he gives in writing his consent by signing, then only you should proceed. Otherwise, there is a specific range, only 70% of amount you should invest in safe assets. Like that, there are protocols issued by SEBI and other investment authorities. They have issued the notice, like this is what you should do with respect to persons who are older or persons who are risk averse. All these things are there. So how you will determine their aversion factor? Yeah, how will you know how averse are they to risk? That how will you find? There will be a questionnaire given by the company or these kind of research firms. That question answer la irukum. Will you prefer this return for this risk? You will prefer. The answer itself will give you how much hours they are to risk. Understand? If you give them retirement plan, this much amount, that much amount, savings, either choose pannive, other choose pannive, and they will say, automatically they will choose this one. Okay, he is not a person who is having a hunger for taking risk for more return. He has not got the appetite to take risk. Ivanala mudiyadappa, ivar vandu romba risk averse person. Using questionnaires, they can decide. Okay, there will be questionnaire by the company. These investment firms, they will issue a questionnaire to understand the investor. And the questionnaire question, you can find out how hours they are investing. This you should document also. Equity research firm and investment firm, they will document these things. How hours this investment, this so and so investment advice I gave, because I assume these are all the risk. So risk management is an entire department there. Okay, they will analyze the risk angle, and then only they will decide what investment to advise, right? All these are there. So it is generally between 2 and 4. This risk aversion number as such will be between 2 and 4, just like correlation between -1 and 1. Here risk aversion will be 2 and 4. Conservative investor will have high aversion factor, and vice versa, which means aggressive investor will have lower aversion factor. ER is equal to X. Now just rearrange the formula. Expected return in a U, the amount of utility, happiness, plus the half of the aversion factor plus into sigma square. This is what is you get as expected return. This is nothing but rearranging of the earlier formula. Yeah? Okay. If at all question may ask this, there is one question I will solve, but it is taken from foreign source. I don't think they have asked this question locally, but still we will not leave anything as such. Okay, understand. When a simple formula, logical also you can understand. The 3 factors are there. You just need to half the aversion factor. You will get the answer. Sigma square. That's all. Correct. Next, for taking a given level of risk, how much return we should expect? Answer depend on two factors. Okay, required utility and aversion factor. Required utility, more the utility we want, more the return we require, and vice versa. More the utility we want, more the return we require. Correct? Because happiness we will get from more return. That is one factor, expected return. Then there is aversion factor, which will magnify the risk. Risk and aversion, I can put it together. 2 factors, risk and aversion all together. Because aversion factor, ultimately what it does, it just magnifies the risk. Are you understanding? Okay, it's just a combination of risk. You can take it as, it is booming risk. Risk is 10%. Aversion, with aversion, it will show it as 20% risk. Understood? Same risk, it will show bigger. That's the magnifying effect of the aversion factor. Next, more the aversion factor, more the required return, and vice versa. It may be difficult for an investor to select a security from the market with single utility curve. Hence, a person enters a market with multiple utility curves having varying level of happiness. I told you na, the preferences will be different. Person 1, person 2, same person, preferences will be different. I told you as an example, you want to marry a high-end girl, okay, then your expectation, after 2 years you are not getting married, na, then you will see, okay, then also you are not getting, na, you will lower your expectation, na. As and when you keep on aging, you will lower your expectation. Like that, it all depends on preferences, okay. So, every investor will see in the market, I will see whether there is any security giving 100% return. Might expect 100% return. See, nothing is giving 100% return. Then what I will do? I will see whether anything is giving 80% return. I will see. Whether I will see 50% return. So, it all changes. Utility curve, you have multiple utility curves in your mind. You will come up with various emotions and select the instrument based on the utility curve. Are you understanding? Little bit more theoretical, that's why I am trying to rush through. Okay. See here, utility curve, graphic based representation. Now come to the core discussion. Risk return, utility curve will be there. This is multiple utility curve, U1, U2, U3. In the previous slide I told you that is different investor. Here same investor having 3 different utility curve. Are you understanding? What is the difference between that utility curve and this utility curve? Anga discuss pannadu 2 different investor. One is aggressive investor, other is conservative investor. Okay,
yes,
aggressive investor utility curve will be always moving higher than the conservative investor's utility curve will be moving higher than the aggressive investor. Why? Because conservative investor will require always higher degree of return. Okay, higher return he will need to compensate for the happiness. For them to become satisfied, they will require a higher return. That's why we discussed that. In the graph, what this graph denotes, okay, this graph denotes about same person having 3 different utility curve. Understood? Same person having 3 different utility curve. This is same investor, U1, U2, U3. He will see whether there are securities falling in U1, first expectation. If the expectation is not satisfied there, then we will go below. Then that is also not satisfied, then he will go further below. Like that, he will take decision. Is this clear? Are you understanding? This is the entire discussion
yes,
of utility curve. Am I done with this?
Yes, sir.
Now what we will do? Shall we solve a problem in this utility curve? Okay.
Yes, sir.
Problem alone you copy. Others I have given in notes itself everything. Okay. Problem alone we will solve here. Okay. A small problem. We will solve and close the session. Tomorrow's session, because I need to continue, there is a continuity here. Tomorrow's session, what I will do, I will link the first part. Market is there, frontier, efficiency frontier is the market available security. Then we have in second hand investor. We analyze the market as well as the investor. Now we need to combine, correct? That combined discussion we will make tomorrow. Now what I will do, investor utility curve we studied, we solve a question, we will solve a question regarding the utility curve. Then I will leave you. Okay, see here. This question, problem under utility curve. Okay, first I will discuss the problem, then I will give time to copy this question with solution. Okay, I think you don't have the question in workbook. I have not included this question in workbook. Okay, but in the notebook you can copy it down. Right, security 1, 2, 3, 4, 4 different securities are there. Expected return is given 12, 15, 21, 24%, which means the expected return is increasing. Okay, as and when the security risk is also increasing. See here, standard deviation of security 1 is 30%, standard deviation of security 2 is 35%, security 3 is 40% and 45%. What is the question? Which security will a risk averse person, okay, risk 2 times mistakenly typed. Which security will a risk averse person investor choose if aversion factor is a 2 and A 2 and B 4. Okay, aversion factor if it is 2, we need to select the best investment. If aversion factor is 4, we need to select the best investment. Shall we proceed? See here, 1 second, I will edit now itself. Correct? Which security will a risk averse investor will choose? Yes, if aversion factor is A2, A4. Which security will a risk neutral investor choose? Which security will a risk lover choose? Shall we proceed? See, risk neutral and risk lovers is a easy discussion. Why na? Risk lover will choose always with a higher return. Very simple, straightforward. Which security will a risk lover choose? 4. Because higher return, more satisfaction. He will be willing to take 45% risk. He doesn't care about risk itself. Risk neutral person will always be indifferent. Are you understanding? Will be indifferent with a 24% as well as risky and non-risky investment. He doesn't care. Appa those two answers will be fairly straightforward. Correct? First person, the risk averse person, which majority of the market are risk averse na. For them only, there will be a selection headache. Which investment I need to select? There will be headache. We will see the answer now. See, step 1. Aversion factor is 2. When aversion factor is 2, security, computation and utility. Security 1. What is the computation? Utility is nothing but expected return. 12% is the return na. First security 12, 15, 21, 24, 30, 35, 40, 45. Remember this, okay? So, what is that? 12%, 0.12 minus half of 2. Aversion factor is 2 na. Into 30 is the sigma na. 0.3. 30 is percentage na. Is denoted in decimal terms. 0.3 square. What is the utility? 0.0300. Second, 0.15 into half into 2 into 0.35 the whole square. Utility is 0.0275. Third security, 0.21 minus half into aversion factor into sigma square. Okay, how much you get? 0.0500. Fourth security, the risk is 24%. 0.24 into half into aversion factor is 2 and 45% risk. 45% for 0.45 square. How much is the amount? 0.0375. Now tell me, if aversion factor is 2, what is which security a risk averse person will choose? A security have a utility. Utility adhigama irukkanuma korava irukkanuma?
Adhigama irukkanum.
Yes, a utility should be maximum. Okay, yes. He will select a security which is giving a maximum utility. Utility is nothing but satisfaction, happiness. So security 3. Security 3 will give the maximum satisfaction. Next. Step 1, aversion factor is 4. Step 2, step 2 aversion factor, when step 2 is aversion factor is 4. How to compute? Utility. Security computation, utility. Same return, aversion factor only changed. Risk is also same. Like that, you will get it as, minus 0.06, minus 0.0950, minus 0.11. For security 4, minus 0.165. Now tell me, if aversion factor is 4, which security he will choose? Carefully observe and tell me.
Security 1.
Yes, security 1, because it is having least negative. Are you understanding? Least negative na, highest only na. So all the security is giving negative utility, which is giving sorrow na, which is giving unhappiness only. Okay?
Yes, sir.
But you will select, anyway you have to select now. What you will select? You will select the lesser evil na. Okay, you will select minus 0.06 as security 1, so that the utility is minus least 0.016. Are you understanding? When it comes to negative na, you will select the least, which means, what do you mean by negative term here? Very simple pa. Your expected return is there na in the left column. See, in the left column is there na. 0.12, 0.15, 0.21, 0.24, 12%, 15, 21, 24. These are all the expected return na. So expected return is not enough to compensate the minus half into 4 into 0.34%. Are you understanding? The return is not enough to compensate the risk, because more the aversion factor na, instead of 2, the aversion factor in this question is 4. It even magnifies the risk higher. Because of that, because of the magnification effect of the aversion factor, aversion factor increase achina, risk is also increasing. Right hand side la risk is increasing na, left hand side la return is there na. Expected return minus half into, that is not enough to compensate. Are you understanding this? That is why less
Yes, sir.
satisfaction. That is why it is not satisfying. Yeah, very simple. I'll show you. See here. Yeah, utility is nothing but expected return. This is one number, correct? Minus half into aversion factor into sigma square. This is second number. Are you understanding? This is 2. Okay, this is the risk side. Clear? This is the return side.
Yes, sir.
For an investor to give a maximum utility, the risk should reduce, return should increase. It's a matching between risk and return, correct? For the extra risk undertaken, whether I am compensated enough, okay, to carry that extra risk. That is what we are judging, na? Okay, so risk side, if it is lower, here what is happening, when risk aversion is 4, we solved the last example, na? Return was 12, 15, 20 and 24, something, 21 and 24, correct? This side risk was same, aversion factor, it became 4, na? Because of the aversion factor, risk increased, okay? Because of the increase in risk, this return is not good enough to compensate that risk. Because of that, in the A minus B in pannache, ये भारी पड़ गया, ये जो risk side है, ये भारी पड़ गया. This became bigger, and because of the entire, it became negative. Yeah. When aversion factor was 2, it was positive. All the 4 numbers were positive. Because aversion factor increases, because the risk also increased, so ultimately the utility also decreased. Okay, we have to select the least utility, that is security 1. Is this clear? Now clear? Everything? Okay.
Yes, sir.
See here from the current slide. Okay. Now can you note it down? This question alone. Others, everything is given in notes, I think. We will see again. See here.
Done, sir. Yes, sir.
Okay, that's it. Now stage 3 tomorrow we will discuss. My efficient portfolio, we will discuss it tomorrow. Right? With this I am closing the session. Thank you very much.
Thank you, sir.